In this video, we're going to talk about bonds. We're going to talk about how we value them, talk a little bit about some of the characteristics. We're also going to concentrate a little bit on interest rates and how that impacts not just bond valuation, but how it affects the economy, buying assets, etc. So when we think about bonds, right, we're talking about this bottom piece here, the component that goes to cost and capital. So what affects this cost, right? So the company's risk, how the company finances its debt equity mix, that certainly has an impact on the cost of debt. But we also have market interest rates and market risk aversion. How does the market view investing in general? So the piece that is most influential on the cost of debt, quite frankly, is interest rates. The company's risk also is very important, but that doesn't change that often. So what are the key features? We've talked about these many times before. The par values, the principal, mostly always $1,000. The coupon interest rate, that's what you get paid for buying a bond. It's paid semi-annually. Maturity, when does it mature, right? When is the bond done? We have an issue date, and of course we have default risk, the chance of not making payments. One of the key features is something called a call provision. This is when the corporation can refinance its debt. So we can refund the debt, that's the more technical term, if interest rates fall. Just like when you refinance a mortgage, this is the way a company, a corporation, can refinance its debt. Now the challenge here is that it is not in the investor's best interest, because if interest rates have fallen far enough for them to want to refinance, any reinvestment by the issuer, by the investor, once the debt is repurchased, is going to be at a lower interest rate, a lower cash flow, if you will. So borrowers are willing to pay a little bit more, right? And lenders require more on these callable bonds. So what is it? Lenders want to get paid more. So that must mean that borrowers are willing to pay more on this debt. Most bonds have what's referred to as a deferred call. The deferred call basically says for a certain number of years we will not call, but then any time after that the bond is freely callable. We also could have declining call premiums. Whatever the premium is set up at the beginning, as the bond matures, as time goes on, that call premium could be reduced. It would never be less than $1,000, though, the par value. And again, this is all about refinancing. What is a sinking fund? Quite simply, this is just a way for the corporations to squirrel away some money and systematically pay off the debt. If you think about borrowing $300 million in a bond, if it's a 30-year bond, in 30 years, you have to pay $300 million. Well, corporations would find it very difficult to have $300 million in a separate account, all for the repayment of this one debt. It's just very difficult to do. So what they will do is periodically, once a year or so, they will squirrel away money. What will they do with that money? Well, they could put that money in a separate little savings account. So let's say the bond is selling at a premium. Well, if it's selling for more than par value, they would rather put the money away and reinvest it in maybe some short-term type of interest thing. rather than buy back the debt because the debt's greater than $1,000. They want to repurchase debt when is selling at a discount. So if the yield is greater than the coupon, if the yield is less than the coupon rate, the bond will sell at a premium. But if it's not over the call premium, the call wouldn't happen. If you want to buy back bonds on the market, of course, we would want to do that at a discount rate when they're cheaper. The worksheet that we can use for these calculations, the bond valuation and duration worksheet, we have par value 1,000, 10%'s the coupon, 10%'s the required return, 10 years to maturity, and the compounding frequency is 1. If you notice, it says coupon per period is 10%. If you do annual payment of the coupon, this would be a 1. That's a 10. If you did semi-annual compounding, which is quite frankly the more frequently way interest is paid, that would be a 2. The coupon would be a 5. These numbers over here always get adjusted for whatever the 2 is here, or whatever that number is there. So this bond would have $1,000 value. Here we have another bond. What would happen if inflation rose by 3%? That means the required return goes to 13%. Well, if interest rates go up, if inflation goes up, interest rates go up, what happens to value? All you need to do is change the required return to 13. That drops the price to $837. So when interest rates go up, bond prices go down, and vice versa. So let's think about how this works with time, right? When a bond matures, they have to pay off the debt. So it's $1,000 principal per bond. So when it matures, in this case, we have a 30-year bond. When it matures, it will be worth $1,000. So this creates some, I think, confusion with most investors and students, because when we think about bonds, we think about stocks investing, and they're not the same strategies. They're not the same. We're not even after the same things. So with a bond, again, let's think if you bought a bond at a discount for $775. In 30 years, it would be worth $1,000. So if you held it for 30 years, you would have a capital gain. And of course, since you're receiving a coupon all these times, you also would have positive income each year from interest income. So this particular bond would earn around 13%. Likewise, if you bought this bond for $13.72, it has a required return of 7%. And again, when it matures in 30 years, it will be worth $1,000. So this bond, if you buy it, you earn 7%, but a portion of it is a capital loss. Why would you ever buy anything that you knew ahead of time had a planned capital loss in it? And the answer is that's not why you're buying the bond. The people that invest in bonds don't care about the prices. They are purchasing cash flows. So the bonds that are premiums have coupons that are greater than the yield. They're paying more annually than what the person actually wants, so it pays or it costs a little bit more upfront. Likewise, bonds below the coupon, the yield rate will sell at a discount. What kinds of people invest in bonds? Not corporations don't typically buy the bonds of other corporations, and wealthy investors don't typically buy bonds because of the high tax rates. Now the bonds, it's lower than it used to be, but now it's still the 21% marginal rate that all corporations pay. We talked a little bit about dividends in some previous videos where only half of the dividends are taxed. All of the interest on a bond is taxed. So it has a higher tax rate. Certainly for individuals that are wealthy, they could be in a 37% tax bracket, and that's a pretty high tax to pay. So we find that most of the investors are going to be investors who are senior citizens, right? People that need cash, and they have typically lower tax rates because they're in retirement. So at maturity, the value of the bond has to be equal to par. The value of a premium bond decreases, discount bond increases, and again, the par bond, stays at $1,000 as long as nothing changes. If the yield to maturity or the required return doesn't change, then the price of the bond doesn't change. Let's talk about yield to maturity. This is the rate of return you earn if you buy the bond at its current price, all the cash flows occur, and then in the end, obviously, it matures. This is that return that you receive. It assumes that the bond will not default. We'll talk about this in maybe a later video about this chance of default. And as long as the company doesn't go bankrupt, you can be fairly certain that you'll receive the cash flows from a bond investment. So here we have a bond, $1,000. It's a 9% coupon bond, 10 years to maturity, compounding frequency is 1, and the price is $887. So this bond, if you purchased it for $887, you would earn 10.91% over the life of this bond. So what's this relationship again between coupon, required returns, and value? We've talked about this a couple of times now. If the coupon rate is less than the required return. So let's think about this. The coupon rate is fixed. That's what the company wants to pay you for this debt. The required return is what you want to receive. Now the question is, what does the company want? They want $1,000. However, depending on various factors, we may not want to give them exactly what they want. So if the coupon rate, what the company wants to pay, if that's less than what I want, I'm willing to lend them money, but I'm not going to lend them the whole amount, so it's going to sell at a discount. Certainly if the coupon equals the yield, it sells at $1,000. And if the coupon rate, if what the company wants to pay, if that's more than what I require, the bond will sell at a premium. And of course, the coupon rate is fixed. This is the yield. The required return changes over time. Why does that change? It changes because of interest rates in the economy, recession, expansion, the riskiness of the company, whether it's the things that they invest in or maybe their capital structure. So there's lots of things that impact the overall value and the required return that individuals have on the company. So here's a quick little discussion about the yield to call and how we would calculate that. Here we have a 10% coupon bond, time to maturity. It's going to mature in 10 years. You can buy it for $11.35, and this bond has a value of $11.34. So right now, this bond has a price that's a little bit over the value. I mean, it's pretty close. So you probably would purchase this bond if you really wanted it. But what about the yield premium? This bond can be called in 5 years, and they will pay $1,050, right? So $1,050, you get that in 5 years, and for the next 5 years, you would also get the 10% coupon per year. What is the return if they call at the end of the 5th year? The yield to call here is 7.5%. Certainly both of these, that number is certainly less than 8. The other one is pretty darn close to 8. So if we thought that interest rates were going to fall far enough to entice the company to buy back its debt, we wouldn't want to buy this bond because our return would be less than if we held it for the extra 5 years. So in general, if a bond sells at a premium, a call is likely, right? How does the bond price get over $1,000? Interest rates have to fall. If interest rates fall, prices go up. So again, on a yield to call, you would expect to earn that on a premium bond, and yield to maturity on the other kinds of bonds. So again, if you're investing and there is a call, it's a callable bond, one of the things you have to consider, what is the chance that interest rates will fall far enough that the value is going to exceed the call premium? So that's it for this video. Look forward to seeing you in the next one.